The biggest deal in 2025 in our database was a $15 billion revolving credit facility.
So you're highlighting a potential concentration risk amongst a few of those larger traders.
Traders are not lenders, and they are effectively lending to peers and even competitors.
Welcome to Trade Treasury Payments, the podcast unlocking the future of cross-border finance.
From transaction banking and money movements
to liquidity, treasury, and cash management.
We bring you expert insights and the latest trends shaping global finance.
I'm Dipesh Patel, editor at Trade Treasury Payments. Today we're talking about the global state of commodity trade finance, and I'm delighted to be joined by our partners at TXF. We have Ralph Ivy, commodities editor. Ralph, welcome.
Thank you so much for having me, Dipesh. It's a pleasure to be here.
It's good to interview you this time, but we're changing it up slightly. Now, TXF have recently launched their report all around what's happening in commodity trade finance, particularly in the last year. And I know things have obviously changed since the start of this year, but broadly speaking, volumes are considerably up. The number of deals about flat. What's the simplest way to explain what's been happening in the market recently?
Yeah, it's an interesting time to be talking about 2025 data. I guess to some extent, a lot of conversations are very much about what's happening right now for good reason, but certainly in terms of the trade finance market, I mean, we like to think that our data report is the most comprehensive that's available for looking at our total commodity finance volumes. And as you say, I mean, the headlines are pretty simple. Volumes are up 25% to roughly $168 billion. But the number of transactions that's been distributed across is pretty much flat at 153 deals. So, I mean, what we can say from that, clearly, the pool of borrowers isn't expanding. I think the other side of that as well is that the pool of lenders isn't expanding or indeed contracting. So existing players are very much upsizing, diversifying. The phrase that we're all quite familiar with and is discussed often at conferences is the flight to size, or maybe the flight to quality. I myself prefer flight to size, certainly. I think the other way of thinking about it is we're seeing a very segmented market in the financing industry anyway. Your average deal size in 2025 was about $1 billion, which is obviously an enormous sum that I think that most commodity companies don't really have access to from their pool of banks. Certainly, there's like this pool of facilities that's really pulling up the average numbers. And I think if you go to talk to any bank, they'll tell you that anything up to $1 billion is now mid-tier to them, which again will be unfamiliar to a lot of the SMEs within the commodities business. But the biggest deal in 2025 in our database was a $15 billion revolving credit facility. At this point, to my mind, this isn't really trade finance in any recognizable sense anymore. It's more kind of, broader corporate funding. I think to underline this, there's a clear challenge here for the commodities industry if, as many would argue, this absence of financing is holding back a lot of prospective high-quality companies who are already or could grow into really important parts of supply chains. And we know how important discussions around supply chains are right now.
And we'll talk about the mid-market and access to capital a bit later, but just drawing on your point about the flight to size, and I think this is the first time we've seen the deal size, average deal size, go over $1 billion. What's driving the rise of those transactions?
Well, there's a few things. Firstly, we always acknowledge that the trade finance market and the commodities business are cyclical. Now, increasingly, a lot of big traders have access to 3-year tranches or even more, which is pretty long term for this industry. So we're always liable at this point to see a few bumper years every so often. And indeed, some markets in 2025 were quite volatile, particularly in the agri sector, cocoa and coffee towards the start of the year. So more volatility means bigger lines, but really, I mean, the big volumes in our database and indeed in the industry are captured within the energy market and the oil and gas business. 2025 and 2024 before were actually years where margins were quite tight for energy traders due to the absence of volatility. So I think what we've seen is that a lot of the larger traders are looking to bolster their balance sheets to help with some aggressive maneuvers on the acquisition front. Vertical integration is a big theme at the moment, and that tends to drive bigger transactions. And indeed, what we would have once thought of as traders becoming supply chain managers in that more holistic sense of the term. So, in 2025 alone, we had Vitol investing in upstream assets in the Republic of Congo and Cote d'Ivoire, Glencore taking on a refinery in Singapore off of Shell. And then the other side of the equation, obviously from the bank perspective, which is something else we can get into, but I think increasingly the regulatory environment for trade finance is challenging. For those banks that have adopted Basel IV now, their capital requirements regulation isn't especially kind to kind of short-term collateralized loans. And so we kind of have this environment where banks are struggling to onboard new clients, and they're now almost disincentivized to do so, particularly when transaction size or prospective transaction sizes are smaller. So for a bank, you can get through the same amount of work on a $500 million deal as versus a $5 million deal. So they're incentivized to invest in their larger, kind of more familiar customers, I think, in that way.
Thank you. And actually, we did a roundtable series, TTP TXF Commodities roundtable series, our first one in London very recently, as we prepare for TXF Amsterdam in just a few weeks' time. What would you say were some of the key findings when we gathered commodity traders, who are lending themselves, of course, banks, non-banks, and geostrategists?
Yeah, I mean, firstly, a very successful first edition of that, and we're very excited to see where we can take the conversation from that roundtable into Amsterdam and beyond. But I think, there's this perception now that there is now, as I started with, a segmented market now, and that the larger traders are now kind of in a different bracket to say the rest of the industry, who operate on what you might call kind of fairly traditional lines within the financing industry and the commodities business at large. And now from a bank's perspective, there are opportunities with large traders to kind of cross-sell, treat them as major corporate clients. And I've mentioned some M&A deals involving traders. So from a bank's perspective, the clients who once would have sat within a kind of trade finance team are now clients of multiple branches of a bank, and they are kind of new entities in that sense. And I think crucially, there's I'm not trying to discredit the deal making that's done by large traders. Indeed, a lot of creativity and innovation does come from those larger borrowers, and we always like writing about them. I think Trafigura is always a good example. They're very kind of ahead of the game in terms of their collaboration with export credit agencies, and there's always some very interesting deals there. They've also been at the forefront of some digital finance as well, with electronic bills of lading. This year, we're very happy to give a TXF Deal of the Year award to a receivable securitization to Glencore. So I think, what I'm getting at here is really the chasm that now exists, and the concern that I know many people have expressed within the industry that traditional trade finance, which remains a very effective tool for borrowers, is being squeezed out.
In terms of the financing itself for the smaller traders on the other side of the chasm, what are we seeing, and what were the key takeaways from our roundtable?
I think, the takeaway that firstly the data shows is that there's still plenty of transactions in that smaller bracket. I think we have 44% of deals in 2025 were sub $400 million, and about half of those again were sub $200 million. So I'm not trying to make the case that there's absolutely no room for SME-sized commodity companies anymore. I think the sentiment that's expressed at our roundtable and indeed in anecdotal conversations more generally is that those SMEs will describe how hard they have to work to go through onboarding procedures at new lenders. Banks have their compliance rules in place internally and indeed for very good reasons. Fraud-related concerns, for one, whether they are sort of justified or not in terms of perception. No bank wants to be on the wrong side of a bad deal. But it is the case that there is a specific pool of lenders, of institutional trade finance banks, and obviously in a market where the pool of lenders isn't exactly expanding, then your relationships with those existing players are really important. And sitting here in 2026, if you don't have those relationships in place for a new company trying to enter the market, it's very difficult then to work your way through those due diligence procedures, which have increasingly become kind of extremely onerous and to some extent obviously sort of take a commodity company away from the core of their business, I think.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it.
Ralph, with the adoption of Basel IV around the world, which I think we also discussed has been uneven, what does the growth of alternative financing, non-bank, private credit tell us about the limits of what was traditionally very bank-led?
Yeah, I mean, as I said, there's a limited pool of banks that are willing to offer significant lending in this space, and that's clear enough. So the market,
and we've seen the exit of some recently as well.
Yeah, absolutely. I mean, 2020 and indeed that sort of few years around that period were tricky for the market around the Hin Leong fraud case. And indeed some major incidents since obviously frightened banks and their compliance teams. So the likes of BNP Paribas did exit the market, and we haven't really seen significant volumes to replace them, certainly from the bank side. So the market often discusses the role that the alternative finance has to play, and in particular the funds that are specialist and offer trade finance. These funds are often accustomed to unconventional business models and maybe slightly riskier deal making. I think it's fair to say they remain a crucial part of the industry for everyone up to that mid tier, because obviously every company at some point needs short-term flexible funding and to use as a buffer maybe in times of crisis, indeed like the times of volatility we're going through now. But obviously the other side of that coin is they're not looking to just sit on a major trader's RCF. They're looking for specialized deals, and they're charging higher pricing for it. So there's a limited number of deals that they can really offer to the market. So there remains, I think, that gap, and it creates this room for, as you've already mentioned, commodity traders to step into that gap. And I think something that was discussed at our roundtable was this role that the very largest commodity traders are playing now as financiers for their own supply chains, which creates what, in some senses is a slightly strange situation where the pool of banks will be quite heavily exposed to a major trader through traditional facilities, and then that trader will themselves then be kind of distributing that pool of finance to companies in their supply chain who might otherwise might not be able to, or might take them a long time to go to the banks themselves. Now, in some senses, I guess traders know their supply chains, they know the risks involved, so I guess it makes sense to some extent. But at the end of the day, traders are not lenders, and they are effectively lending to peers and even competitors in some case. And I think there's legitimate questions to be asked about whether that is a healthy model for the future.
Very, very interesting. I think one thing that was also apparent in our roundtables was obviously, commodity traders like volatility. Volatility is good for the market, but in 2026 it started with quite a storm. Are there still areas of vulnerability during these times of volatility?
Absolutely. Well, the first thing to say is you're absolutely right. Traders thrive on volatility, and then consequently banks can then lend more to them in many cases. So in some senses, the current volatility is a boon for trade finance. We've already seen the big traders go to banks for pretty short-term emergency liquidity facilities. Trafigura, Vitol, and Gunvor have all raised sort of a few $1 billion over kind of 3-month tenors, so not long term at all, but just to, as I say, to act as a buffer in these times of crisis. So I think in some sense, the sort of traditional trade finance banks are happy to receive profitable business, but then I think the consequences tend to play out a bit more over the medium term in these cases. Clearly, there is a lot of money to be made in commodities at the right time, and we saw that in 2022 and 2023 in the sort of in the wake of Russia's invasion of Ukraine, and the balance sheets of the major traders still reflect that, but that tends to attract a lot of new entrants to the industry. And if we think about the commodities business as a cyclical one, then you do wonder if it's healthy for the industry to go through this cycle of price volatility, where in times where prices are high, new entrants are attracted, and that's both on, say, the borrower side, but also on the lender side, where say banks or funds are happy to get in on the action and start handing out term sheets. There are obviously fears that with that, fraud cases might rise with sort of disingenuous actors, perhaps trying to get in on the industry whilst there's a lot of money to be made. But we know where the story goes. Like, inevitably, prices are going to come down in the medium term. We obviously have no idea how the conflict in the Middle East is going to play out, but we've seen it happen before, right? Like at some point in the next 12 months or so, when prices fall, some participants in the market are going to be burned, and that might be, say, alternative funds who've tried to step into the industry too quickly. It might be existing commodity borrowers who have maybe ramped up their activity and not been able to secure lines of credit to support that business. So really, I mean, like I say, it's the kind of thing where the consequences will reveal themselves, I think, a bit further down the line.
It's interesting because let's be honest, commodity trade finance, as those interest rates come back down, they can't afford the kind of margins or returns that are offered during high interest rate periods, right?
Yeah, absolutely. This was again another factor of the last few years, is that in a high interest rate environment, far beyond the commodities business, a lot of lenders suddenly look more attractive, right? And indeed, I think one thing we did see was that a number of alternative lenders tried to take advantage of that, sort of from 2021 and 2022 onwards. But that isn't necessarily a sustainable business model, particularly in the physical commodities business, where lenders really have to be proactive partners, I think, in the life cycle of a transaction, and understanding how a commodity trade works and how risk management actually happens kind of on the ground. And yeah, I mean, in a lot of cases, I think some lenders have been found wanting in their risk management capacities.
Yeah. And I guess probably conversations that will happen during TXF Amsterdam, but given what we're currently seeing in the market with regards to current funding and concentration trends, if those continue, where do you think the commodity finance market is headed towards the end of this year?
Well, I don't like to catastrophize, because, like I say, there's still a healthy market out there, and I think one of the key lessons from our report is that clearly there is a pool of finance that is available and that banks can tap. It's really just a question of access at this point. The phrase that was mentioned to me in a conversation not too long ago was access to flow and access to capital in the context of the commodities business. So, and indeed, one leads to the other. So the commodity traders that have access to capital can more easily access the flow of commodities, which is then kind of a self-perpetuating cycle almost, because I think large commodity companies are now almost insulated and indeed too big to fail in some cases. Again, to go back to the fraud issue, a lot of traditional SME commodity companies are not quite asset light, and so when a shock comes, they tend to they're more affected than their larger peers who have kind of the global supply chains to absorb that kind of risk. But yeah, so increasingly, if a specific group of traders have access to capital and exclusive access to capital, then the concern ultimately is about the capital that is left over for the remainder of the industry, which at this time remains sort of fairly healthy and diverse. But if, as I say, access to banks is limited to an increasingly small pool of companies, then the access to the flow of commodities, which they can access through prepayments and that kind of thing to producers, is increasingly limited as well. I do worry that increasingly we're in a scenario where a group of traders have access to capital, and indeed, following on from that, they can use that to access or to secure greater access to the flow of commodities, and increasingly they're happy to use that to their influence over the market, and to perhaps absorb margins that might once have otherwise sustained a lot of other competitors in the business. And I think to come back to the core of it all, it is important for the commodities industry to have a vibrant and indeed diverse group of SMEs that still operate. I think big producers and traders still rely on SMEs as part of their supply chains, and in many cases, smaller companies are much better placed to adapt to the needs of a particular market, a particular region, and a scenario where they are struggling to access financing, or indeed exclusively reliant on their larger trading partners for that finance is not one that's especially healthy.
Thank you very much. So you're highlighting a potential concentration risk amongst a few of those larger traders, and I'm sure we'll be continuing those discussions plus many more on the 11th to the 13th of May at TXF Commodities in Amsterdam. We're delighted to be media partners at TTP, so can't wait to join and see you there.
Yeah, looking forward to seeing where the conversation goes.
Thanks, Ralph.
Thank you.
And don't forget to follow Trade Treasury Payments
on your favorite podcast platform.
Thanks for listening.